It's good. You know it's me, Jason Perez, here to talk about death. No one else but Jason can deliver death, right? But let's talk about the benefits. Let's talk about all the things that your beneficiaries, the people that you leave your money to, are going to be able to buy when you kick the bucket if you have these type of life insurance policies. What type of life insurance policies are you talking about, Jay? I'm talking about the basic ones, like simple term life. Like, think about it. I'm a dude, I got kids, right? Wife gets pregnant, she carries it to term, right? 9 months, term, time period. Yeah, don't make it more simple than that. Life insurance, term life insurance, is about as basic as it gets because it's just insurance coverage. Like, if you have a term policy and you don't die during the term of your coverage, so let's just say you have a 20-year term. If you don't die during that 20 years, you get nothing, right? That's a little foreshadowing because isn't all insurance contracts like that? If you don't die, you don't get your death benefit. In health insurance, if you don't get hurt, you don't get health care. Like, it's just how it works. You don't get sick, you don't need a doctor. That right there, my friend, that's an aleatory contract. All insurance contracts are aleatory. I'm gonna remind you of this every time we go through little examples about life insurance and stuff. Why? Because I could pay you on one of these term policies. Let's just say you're my client. I sign you up today. You were approved today. Your policy is issued today, right? You gave me like $200 for $1 million policy. You leave and you're like, oh, thinking about this $200 you spend. You pull out in traffic, whack! You get hit by a dump truck. Done. If you had $1 million policy, this aleatory contract means that the amounts of money that you're exchanging are not equal. If that was $1 million term policy that was going to be in place for a term of, let's just say, 30 years, and you only made the first payment, and that policy was in force, and you died, I don't care if it's leaving the office, if that policy was in force, they're paying you $1 million despite the fact you gave them like 200. Aleatory, the amounts you exchange might not be even. On the flip side, though, most term life insurance policies go unclaimed. When I say most, it's above 70%, probably closer to 80%, meaning that these people have these term life policies and they're worried about covering themselves. Like right now, I may be 48, but baby, I'm in my prime. I'm an entrepreneur. Like theinsuranceSchool.com, if you didn't know, right now we're like the largest independent insurance school in Florida. Anyway, look, that's enough about me. Regardless, I'm in my growing phase, right? So let's just say I couldn't afford one of those expensive whole life policies that we have to pay for my whole life. It's not a term policy. That's what I would use. If I didn't want one of those policies that had cash values, right? See how it just, we're gonna get to that in a minute, but the cash value doesn't sound like, you know, your car. If you paid your car off, it has a cash value, right? Just keep that in mind. So anyway, if right now in building a business, I still want to protect my family. So a term policy is basically designed to protect me during that time period while I'm in aggressive growth. Very inexpensive because there is no cash value. If during that 30-year term or 20-year term, I don't die and I make that $200 payment every single month for that 30 years, I get nothing. It's an aleatory contract. The amounts we exchange could be uneven, right? Insurance only covers you if that event happens. We're talking about life insurance, which means unless you modify this contract to include more features, you don't get it. You only get paid if you die. Well, luckily for you, we're more likely to be injured, you know, and need 90 days worth of care and long-term care or something like that than we are to die, especially at our age group. So that's like your best case scenario there. That's foreshadowing into how we modify these term policies, right? Anyway, there's three major types of term policies that you know. Now, there's a lot of different ways to modify them, and we'll get into that. But right now, I need you to know the three different types of term policies that we're going to be tested on, okay? The first one is a level term. What that means is that we're picking a term policy that's going to cover me for 20 years, right? And the death benefit associated with it is $250,000. Easy, right? Easy peasy. That would mean a level term at the end of that 20 years, if I die anywhere in there, even if I die like right before the policy expires, it never goes up, it never goes down. The benefit is that flat $250,000 level. You picked your time period and you picked your amount, and throughout that time period, it doesn't change. Now, if I'm telling you and I'm starting off with one that doesn't change, obviously the other two do change. And what they do, one of them depreciates. So I might have started with a $300,000 life insurance policy, right? But it's a depreciating term policy. Why on earth would we get a depreciating term policy? Good question. Think about your house. You're sitting in the house, you borrow $300,000 for your house. Well, a depreciating term policy is like collateral in a lot of instances, right? I would feel better if you were to kick the bucket and I lent you $300,000. I would feel better if the life insurance paid me the $300,000 that you owed, right? But in a mortgage scenario, you have to think about it this way. If I bought that house today and I have this 30-year term, right, on my mortgage, and I get a 30-year depreciating term policy, in the middle, like 15 years later, as I pay this down, maybe I only owe $150,000. Well, my policy is going to move down along with my debt, so that way it's kind of in sync. That's a very good way for you to remember depreciating term is just to tie it with a house. As you start paying off your loan in your house, you're building equity in your house, right? So as you go ahead and you pay that down, the benefit decreases, because why would you give your lender a level term? 15 years into this, if you paid $150,000 and you were to kick the bucket, do you want me to go ahead and pay your lender $300,000? Absolutely not. Depreciating term. The last one is increasing term. Well, if one's staying the same and one's dropping, one's got to increase, right? Well, just take, I know I'm jumping ahead, but I know one of you guys just said, yo, Jay, why does it increase? It increases because sometimes we go through years like this where I'm not going to say no names, but government spending gets out of control and all of a sudden we got inflation, right? Inflation means that money, as we start going, we have a $300,000 policy that we put in place today, right? Is it worth $300,000 in 30 years? Like, yes, you would still get $300,000, but would it go as far in 30 years, 300 grand, as it would today? No. That's the reason for the increasing term. The increasing terms are usually tied to some kind of consumer price index. So as inflation goes through, it allows you to go ahead and purchase more insurance at a later date without evidence of insurability. But I'm kind of jumping ahead here because when it's without evidence of insurability, it's one of those things called a cost of living rider. Kind of makes sense, right? Cost of living rider. That's what we're talking about. We're talking about how do we make sure a 30-year policy that we put in effect today is worth exactly what we need in 30 years. We make sure that it keeps up with the cost of living. And that, my friends, is how we're going to open up this life section, because right now we're going to make sure that you know what a term policy is, what a whole life policy is. We're going to go through the annuities and everything, but we can't get there if you don't understand the basics. And those right there, my friends, are the basics. You can either have a term policy that stays the same throughout the entire term. You have a $100,000 benefit on day one. 20 years later, when it expires, you got a $100,000 benefit. Decreasing term goes down in increments, probably to coincide with a creditor and a debt. The last one is an increasing term that allows you to purchase more insurance at a later date. Now, if you don't have that cost of living rider, you may have to prove evidence of insurability. But if I sell you something that allows you to buy more insurance down the road, then I'm probably going to allow you to buy that insurance without making you go through underwriting. That's why you want to talk about that cost of living rider and let that sink in a little bit. We're talk about that in the next section. In the next section, we're going to talk about how you can renew a policy and convert a policy. Convert it to what? Convert it to one of those whole life policies with that cash value. Blah. 10 minutes, 26 seconds. That was pretty good though.
Yeah, when you hit the topics.
Yeah.